They always say that you should not put all your eggs in one basket. That means that that basket contains all your eggs, all that you have, or all your hopes. Those hopes are the portfolio. As an investor, you don't need to invest in one. You don't need to put all your money in one asset or one investment. You need to have variety of investments. Those groups of investment will brought together, they are called portfolio. The reason why we are having portfolio is so that we can reduce the possibility of risk. Let's say that you have invested in an industry like tourism industry, and there is COVID. Definitely that means that the tourism industry will go down. But then if you have money in finance industry, people will be using mobile banking to do transactions. So financing industry will increase. Probably education industry will also be affected. And if you are invested in a different industry, maybe food industry, it will be booming. So the economic conditions can affect such that at some point you have money coming in very well from one area and another business, the industry has been affected. Now we have risk that affects the business. Those risks are called systematic risks. Now when we have this like this, right? And then we are having systematic risk. So systematic risk is the risk that cuts across. You cannot be able to diversify or reduce it. You cannot reduce it by having different assets, which we call diversification. Diversification means that you are investing in different assets. So you cannot be able to reduce it through diversification because it cuts across. That is called systematic risk. Systematic risk. It is normally called beta. That risk is what we call beta, systematic risk. And then we have unsystematic risk. So this is the column for risk. So the risk level increases like that from maybe 5, 10, we have 15, we have 20. That is business risk. It increases like that. Business risk include both systematic and unsystematic. Systematic is the one that cuts across all industries. You cannot say that now I'm moving from this to this. Like political instability can affect every business, right? But then we have some that affects only one industry, maybe financial institutions or financial sector or tourism sector, education sector. Those ones are called unsystematic because they are only affecting an industry and not all of them. So they are called unsystematic. Now those ones you can reduce. This one is a column for portfolio. So as you increase your portfolio, you are having more assets in your basket. You are having more assets in your basket. The risk level, which is unsystematic, reduces. The risk level reduces. So you can reduce risk to zero. This risk you can reduce to zero mpaka ubaki na unsystematic only. Ikiguza hii, it means that now unsystematic is done. Unsystematic risk has been reduced. Umebaki na, it is now zero. So chenye umebaki now ni hii peke yake. Hii ni systematic risk. Unsystematic has been reduced to negligible or insignificant audit. So this is how risk moves. Now, most of the time, we reduce risk by investing in some risk-free assets like treasury bills and bonds. Those are government investment. They have to pay back. They don't have any risk. If they have any risk, or maybe the government lack money, they will come and tax you more. They tax more, and then they get money. So that's how these graphs look like. Now, you can write and say that portfolio is a collection of assets or investment. The objective of portfolio is to reduce risks or to minimize business risk. Portfolio is a combination or collection of assets or investment with an objective of reducing risk. There are two types of risk. We have two types of business risk. and that is either business risk, that is either systematic and unsystematic. Systematic and systematic. These are the kind of risks. Then I want to proceed and say that systematic risks are risks that are uniformly distributed to all companies. It is uniformly distributed to all companies in an economy. Kila kampuni, it is system, it cuts across. So mtu akisema hiyo ndio system hapo, hiyo ndio system, that is how it happens. It means that hata ukienda kwa teller B or teller A or C, you'll be treated the same way because that is the system. Then, so it cuts across. It is a risk that affects everything, every business in the industry. And then we have unsystematic risk. Unsystematic risk. Unsystematic risk affects only specific companies it affects only specific companies or specific industry. It affects only systematic specific companies or specific industry in an economy. Only specific ones. Like for example, poor management, low interest rates. These ones can be avoided by diversification. They can be avoided by diversification. Now, this risk can be managed, but sometimes when you have different assets or different risks, you have different assets, then you need to understand that these assets, you can be able to get average return. So, for example, in ordinary situation, you would say that we have 10 assets. So one asset can give a return of 10 million, another one 12 or even 20, like that. And someone tells you, can you tell me the average return for the 3 assets? You need to add all of them and divide by the numbers here. So you add this, get there 6. Then here we have this is 56. So 26 divided by 2, that is the average 28. That is the average return. Now, this one, you can also now get it through probability. And therefore, we are introducing the concept of probability in risk management. You need to ask yourself, what is the probability that I might lose? Then you average and get it. So let's look at that very fast. So let's say that we have probability. This one is just an example. So we have probability here of 0.3. We have 0.2. We have 0.5. Then we have return X. At least I'm recording. I thought I'm not recording. Because I record si Florence ananimaliza. Yes, I'm recording, I'm happy. 10%. Then let's return. Now, these returns, they make sense. These returns, you can say that is a return on asset or security. They mean the same thing. Whether it is asset or security, they mean the same thing. So, now again, those returns are in percentage because when you are investing, say, in treasury bonds or treasury bills, we shall not ask you how much are you going to gain because we don't know the amount that you placed. But we are asking you, when you invest there, what is the return in terms of percentage? So tell us, when I invest here, my return will be 16% per month or per year. The same, when you invest in some shares in a circle, you will be paid some dividends. Those dividends are in percentage. It is the percentage that we are concerned with, the average return in terms of percentage. Amount depends on your effort. Amount is about your effort, right? So we have there 14%. That is why we call this one return. And then, so that is an asset, the first asset. Then we have the second asset. So return on X, on Y, on asset Y. So we have returns on asset Y, and we have returns on asset X. So here we have 12%. We have 18%. Then we have 21%. Now, you see this one is the average, is the total return in X. X only, one asset. There is a possibility of 0.3 that you can be able to get 10%, 0.2 that you can get 12%. So for you to get average, what we call expected return, you can get expected return here, the same as average return. So what is expected is the mean expected return on number one, A or X. X, it is this times this plus this times this times this, like that. So that you can have the expected return is 0.3, because that is return for one. But then, now that you have different probabilities, you can get the expected. So we have 0.2 times 10 plus 0.5 times 14. So we have here how much? What's the expected return? What you expect in average? Ile minimum you expect from X in average. That is what we call expected return. So the mean return there, mean return, this one looks like 3. This one is 2 point. So we have here 3 plus 2.4 plus 7. In the 7, right? So total here in Abuja 12.4 should be 12.4. Eh? That is the mean. That is the average. Then we have for B, we have expected return for C, and then for Y, expected return for Y is now 0.3 times 12 plus 0.2 times 18 plus 0.5 times 21. What is the expected return there? You calculate, you'll get 17.7. So these are what you expect. Now, somebody can ask you now, determine the standard deviation. The term deviation, standard deviation, is from the word deviate. Deviate. Means moving away from something. And whenever you are expecting, this is what is expected, but you're not deviating, moving away from that. It means that you're taking a risk. For example, if I told you that, can you draw for me this thing? So it should be drawn like that. Like anyway, umechora hivi. There is a risk that you're moving from what is expected away from it. So what does that mean? You are becoming inaccurate. Sindio? That is inaccuracy. So if that is a risk, by moving away from what is expected, you are becoming inaccurate. The more far you are, or the far you are, the more the inaccuracy level. So therefore, in standard deviation, we are looking at how far are you moving from the expected return to where you are, right? So let's look at standard deviation. You know the mean where we are supposed to be for each unit, but then you have decided to move away from there. So you're taking the risk by becoming inaccurate. So we can have the second question, which is standard deviation, determination of standard deviation. So standard deviation depends on asset. You need to check how this one deviates and how this one deviates. So you get them separately. This one that we call expected return, you can say expected return, right, of X. Or just say expected return, that is ERX is equal to, una calculate hivyo. Then expected return of Y, una calculate hivyo, right? But if it is mean, we call it expected return mean. That is mean. Mean, you put that one, right? That means that you're deviating from the mean. But anyway, let's now calculate deviation. So deviation, you have the formula, which is the risk. So risk of X, that is the standard deviation, risk of X. You are risking to go away from that. So how do you calculate it? I can see somebody has typed something. 17 point. Thank you so much. You are helping me. So we need to look at how these ones move from each other. So you'll be able to check. You have this, right? So you'll add all of them. So we start with the first one, 10. This is the return that you're getting. But you're supposed to have 12.4. So there is a possibility that you're telling. If you get 10, when the mean was 24, 12.4, and 20, is it? Yes, 12.4. But we're on about 10, then that means that the first scenario is that you're moving from it by a certain percentage. So you have 10 minus the mean, which is 12.4 squared, right? You're going to get some answers there. Plus, the other one is 12 minus 12 minus 12.4, because that is the mean, square, right? Plus, the last one is 14 minus 12.4 squared. Times the probability for each. So this one times the probability 0.3 times 0.3. No, 0.2 times 0.2, 0.5. So get me the answers here. So it is how this one has deviated from the mean times probability. This one from the mean times probability. This one from the mean times probability. Now you need to be careful so that you don't just get it. You have to square this one. You have to square them. Once you've squared, you get the square root now for the total. So get me the answer there. For the first one, unapata ngapi? Somebody assist me calculate. So what you're going to do, 10 minus 12.4 squared times the probability, its probability. So it is 10, that is negative 2.4 times negative 2.4. The answer is times 0.3. 17.1.728. Then here, we're going to have 0.4 times 0.4 times 0.2. Then get me the last one. Get me the last one. Then the total. Get me the last one, then the total. So you get in total of 3 point. So this other one is 1.28. Eh? So you get a total of 3.04. Now get the square root of this. Get the square root of 3.04. What do you get? One point seven. 436. Can somebody do for me for X, for Y? Let's now calculate for Y. I'm giving you 2 minutes. Calculate for me the same way for Y. Standard deviation for Y, hapo chini. So tumepata ni ngapi? 3 point? Thank you. 3.9. Higher. So after that, we have seen the standard deviation. Now from standard deviation, you can get covariance. It is just flowing like that. Standard deviation we have done. So the next one is covariance. Na hizo ndio wataleta kwa mtihani, sio kitu ngumu kwa hii topic. So from the word co, it means that you are comparing how each is varying with its mean. So for covariance, you always compare the two. You can't get covariance for one. You compare covariance for one and another one. So that is covariance. You say co X and Y. So you are seeing co means that there are two. So you have to compare how two is varying and also Y is varying. So let's have this. It is just the same way. You get summation of each. That is how one is varying and the other one. So you can start with x. That is return of x varies from expected return of x. Then you also have return of y varying from expected return of y. So return of y varying from expected return of y, right? And then now times the common probability times the probability for each. So we can do the first one here. You'll have 10 minus 12.4 into 12 minus 17.7 times the probability in that line is 0.3. Get me the answer. Probability in that line is 0.3. Probability there is 0.3. What is the answer? And then you go to the second one and the third. Okay, so the first one you're getting 4.104. The second one, you also look at how this varies. So 12 minus its mean, which is 12.4, into 18. 18 minus its mean, which is 17.7, then times 0.2. So what do you get? That is 0.2, what do you get? You're getting negative 0.264. Okay, is that what all of us are getting? So here we have 12 minus 17.7 times, this one is 0.4 and negative 0.4, because it is 0.4. No, negative 2.4, negative 2.4. That is 13. Able to side here, what are you guys getting? Eh? This one minus this, that is negative 15, negative 5.7. This one is negative 2.4. So you get that times 0.3. Oh, that's the first one. Oh, the first one is okay. So here we have negative 0.4 times what do you get here? 0.3 times 0.2. I'm getting 0.024. 0.024. Kwani nyinyi mna calculator aje jameni? You're getting the same answers. Is in 0 point, in negative 0.4, sindio? Times negative 0 times 0.3. This one is 0.3. Here alone is giving you negative 0.12 times 0.2. Unaweza pata hiyo 6 inatoka wapi? Hiyo 6 inatoka wapi? Hii ni 0.3. Hii ni negative 0.4. So I think there is a problem. The correct one should be this. So check. Now, the next one is this one here. 4 minus 12.5. 14 minus 12.5 into 21 minus 17.7 times 0.5. What do you get? So here we are having 3.3. Still 21 minus 17.7. 3.3. Here we are having 14 minus 12.1. So times 3.3 times 0.5. Right of this time. Ni kama ulikuwa unapata hii. And that is negative 0.024. Iko sawa. Sawa. Now let's add them. Add the total. That is the covariance of y and x. You don't have to have the square root. Square root is only on division. On division. So it is 6.72. 6.72. Now the next part is now coefficient or variation. Coefficient, correlation, coefficient. That is correlation, coefficient between x and y. Between x and y. So between x and y, the formula for correlation, which we call R, correlation you can call it R. So you say R, X, Y, or just say correlation between X and Y. You can get it through covariance of X, Y, all over standard deviation of X times, this one means times standard deviation of Y. So this therefore means that you must have done, in exam if they ask you to calculate correlation, it means that lazima, by default, lazima upate covariance na lazima upate standard deviation for each separately. Covariance and standard deviation for each separately. So you can see that is what you need. So even if the question was to ask you about this only, automatically you know that you must have this. So that will be 6.72 all over. Standard deviation of the first one was 1.7 times 3.9. So what are you going to have? We're getting 99. Thank you. 0.99. Maana ni vile na rahisi. Na unateremka tu. Aya, let's now get to the last part or second last part. Assuming that the investor here or the business here, the businessman here, bought 75% of security X. You know, you could be having like 100,000 or even 10 million and you want to diversify. So what you'll do, you'll take a certain percentage, like even 50%. That is 5 million. Or you can take 7.5 million, you invest here, then another 2.5 million, you come invest here. So that means that at that position, We are talking about a situation where you have two investments and you have some money. So you need to decide what proportion to be placed here and which proportion to be placed here. So we are talking about the percentage. So assume that investor has decided to invest 75% on X. That means that without being told, they only have two assets. It means that now the remaining 25% to make it 100 is obviously invested in Y. So this one is on X and this one is on Y. Now, you might not know the amount. You might not know the amount that they're investing, but they still have to ask you a question here. They will ask you the expected return of the portfolio, the return of each portfolio. Now, this one is giving you the weight. This is a different way or indirect way of getting the weight. The weight they could have told you that the investor had got 10 million to invest. Here, when we compare that investor had got 10 million to invest, it has invested 2 million on X. On X. That means that weight on X should have been 2/10, which is the same as 20%. So whether umepewa the amount or percentage, you can still arrive at the same point. 2/10 is 20% still, which is the same as this. So they have given you weight indirect in terms of percentage. If they give you in terms of figures, you can use the figures and get the weight. Now they are telling you that you need to calculate or determine the expected portfolio return. Determination of expected portfolio return. So expected portfolio is written like this: expected portfolio, expected return of the portfolio in an equal. Expected return of the portfolio. So the expected return of the portfolio is normally the weight of X times return or expected return of X plus weight of Y times the expected return of Y. If there were 3 assets or more, you come to another one plus weight of Z, expected return of Z. So you need to keep on moving like that. But here there are only 2. So we can easily get our expected return of the portfolio because we only have 2. So you weigh them. So you have weight of X, which is now 75%. So we can say it in terms of decimals, 0.75 times the expected return was 12.4 plus expected return of Y was percentage is or weight is 0.5 times the expected return here, which is 17.7. So what do you get in total? $13.723. That is how you can do it. Very simple, right? Now, the other question is now determination of expected portfolio risk or risk of the portfolio. Determine the portfolio risk. Determination of portfolio risk. Determination of portfolio risk. So risk of the portfolio, which you say that is written like this. If you say this, that is the risk of one security. But we are not talking about that. We're talking about the portfolio. So it is P. You can have the formula. The formula is very long. So we have that. Then you say weight of X, risk of X squared, right? Plus weight of Y squared times risk of Y squared plus 2 covariance xy, 2 covariance of xy, weight of x, weight of y. It is the only formula that is quite long in this particular illustration or in that particular question. But once you master it, it is just fine. So we have weight, which is 0.75 times, we have the standard deviation there of x was 1.74 plus weight of y, which is 0.2 times the standard deviation, which is 3.9. Of course, these are squared, so you need to square them, plus 2 times 6.72. Was it 72 or 74? 72, still, times the weight of y and the weight of x. So the only one that you have for hapa, which you can calculate. Can somebody tell me that? What is the answer here? Let me get the square root of the total answer. Somebody to get me that, the total. What do you get? This one is actually 2.5. 0.25 squared. Can somebody get me square root of this? Get me the square root of that. 36, yes. You're getting 2 point? So you can say like that. That is the end. That is the end. Thank you. All of you are right. So up to there, you guys at least can do something. I'm hoping that up to there, you can be able to answer some questions. Let me see if there was another question like that. We are not doing it, but we just want to read it. Now this one. So they have given you Simon Kobia, an investor, is evaluating 6 portfolios with the following characteristics. We have portfolio number 1. Expected return is this. They have calculated the expected return. They have given you the standard deviation. So the expected return of the market portfolio is 12. That is the ER, the market ERM. With an remember, these are not securities. These are portfolios, meaning that they are group of assets already. So with an accompanying standard deviation of, while the risk of the risk rate of the interest is given like that. Using the capital market line, advise the investor on which portfolio is inefficient, efficient, or super efficient. Have you done that one where we do the efficiency? You look at efficient, inefficient, and super efficient. Okay, so let's do the last one, and then we can move to that efficiency area, efficient portfolio, and the capital market line. So we have zero risk. So zero risk portfolio means that that is a portfolio which does not have risk at all. You know, these other portfolios have got risk, and that is why you are able to calculate the risk of the portfolio. But this one does not have a risk. So it means that the standard deviation is 0. Now, you can say that these are portfolios that have 0 standard deviations or risk. They have 0 standard deviation, which also is risk. They have portfolios that have got 0 standard deviation. They have portfolios that have got 0 standard deviations. They are portfolios that are created by extremely risk-averse individuals or investors. They are portfolios that have got 0 risk or 0 standard deviations. Portfolios with 0 standard deviations. Portfolio with 0 standard deviations. They are portfolios that are created. They are created by extremely risk-averse individuals. They are created by extremely risk-averse individuals. They are created by extremely risk-averse individuals. The optimal proportion, you know what it means, the percentage, the weight. It is the same as rate, which you can get in terms of percentage. So the optimal proportion for this, the optimal proportion of zero risk portfolio are calculated as follows. Optimal proportion, let's say that one of the portfolio is A. The optimal proportion, if you get A, then automatically you'll be able to get B. Still, if A is 10%, then B is 90. So you can use one to get optimal portfolio. This is the risk minus covariance of A and B, just like you are having for X and Y, right? And then standard deviation of A squared plus standard deviation of B squared minus 2 covariance A, B. 2 covariance of A and B. 2 covariance of A and B. This one is for B. So that is the formula for getting the best weight, the optimal weight in that case. So can we use that example to calculate this, the example that we have just done? The example, using the above example, we can have, meaning that if you diversify your portfolio well, at some point you'll be having zero risk. So let's say, how do you balance the money that you have between these two assets so that the possibility of having risk is minimized? So they can call it minimized risk or zero risk, or nil risk in exam. They can use the word minimized risk, but they are referring to zero risk or nil risk. So ukiona wamesema minimized, usikuja useme that mwalimu, you told me about the zero risk but not minimized. It is the same thing. So weight of A. So let's say that the other one is now weight of X is equal to square root of Y, covariance of XY over the risk of X plus risk square of Y minus 2 covariance of X, Y, which you can now calculate. So with that example, we have 1.7, 3.9 squared minus covariance of this one is 6.72 over 1.74 squared plus 3.9 squared minus 2 times 6.74. So which weight, what is the best weight or allocation of mass? What percentage can you allocate to Y and X to make sure that in that portfolio, it has zero risk? So get me the weight for, that will give you the weight for X. And then the opposite is the weight for Y. Calculate for me this and tell me, how do you balance your investment to ensure that you have zero risk? How do you balance it to ensure zero risk?
Dennis, I have a question.
Proceed.
Does it mean that we will only have the weight of A, but not even B?
The weight of?
Does it mean we will only have the weight for A, but not B? How about if they have given the two portfolios of A and B?
That is
what will be?
No, that is what I've said. Say that if you can get weight of X, that is the first portfolio, then automatically the difference is the weight for Y so that you can have 100%. So kama X umepata ni 80, then that means that Y is 20.
Okay, so
you can start with B. The only thing is that if they ask you to start with B, then now here, you make sure that you only change this. Kama hapa ni B, then this will be A. The rest remains the same. So,
okay, so
so wakiweka B hapa unaweka here. Then now, see hii iko hapa, the same, hii the same, hii the same. So you're going to get for B, and then now you can calculate for A. Because the examiner can ask you for any. So what is the answer? I was waiting for you guys to do this, but ni kama hiyo mtafanya baadaye. So let me, because it is only answer now that I need. Look at this. This is which sitting? November 2016. November 2016. They are saying that Moses Mapesa is in the process of evaluating investment in 2 companies whose percentage returns in the last 10 years are as shown. So we have this, these are the years, then we have these are the returns. So we have these are investments, just like we have here, investment or security X and Y. So these are FSN limited and also investment in this. So you can make this thing in a way that makes sense for you. So you can have year 1. We have 1, 2, 3, 4, 5, 6, 7, 8, 10. Or 10, 9 and 10. So we have F, S limited. And then we also have SN limited. Then we have here. These are returns. So 2, 3, 4, 5, 6, 7, 8, 9, 10. And these are returns, just the normal return. They are in percentage. So we have 37. And then here we have 32. Then we have 24. 39. Hiyo watu wengine wakiona kitu imechorwa hivi, they get confused, including me. When I was a student, niliona hii kitu nikaogopa, hata sikuwa nataka kufanya. Mbona wanachora vitu vingi hivyo? So ilikuwa inanibore. But then I realized that this thing you can put it the way you want. So this time round I've decided to put it the way I want, so that we see how it can be solved. Now, 80s, 21 and 18. Yeah, now we have 6, now 18, 27. Then we have 6, then we have 10, 6 and 10. Yeah. So how do you get correlation coefficient of this company? Can somebody first get us the expected return? They're in percentage. What is expected return? When you're not given probability, how do you get the expected return?
Summation of X over N.
Huh?
Summation of X over N.
Good. Then you get the total. So basically, you take this, you get the sum of them, all of them, and divide by 10. Then also the same is the same with that. So you need to get your expected return, which is the same as average. That is summation of all this. So that is a total of all the return. Summation of all the return, over the number of years. Then you get the other one. Then from there, they're not asking you to get correlation coefficient. So we know that for you to get the correlation coefficient, then you need to have gotten the covariance and standard deviation. Now, without being told, examiner has told you direct correlation coefficient. Now, umeona max sio kadogo. How much? 6. So basically, this examiner is trying to tell you that you need now to get covariance, then you need to calculate the standard deviation. So you need to calculate them separately, and now you have covariance over standard deviation of the first one, and then standard deviation of the second one. Then from there, they are also telling you to do what? Proceed and now get portfolio risk. They are not telling you that we have to get risk for each portfolio risk, and you know the formula for portfolio risk, 2 marks, which you have just done. So here in a car easy. I wanted to look for one in May, same year. I hope that this one you watched, before I watch your videos that I shared, equal up. What I want us to look at is called Mary. Question number 2C. They are saying that Mary Chege, just after this, Mary Chege has been investing in the shares of various companies quoted on Securities Exchange. Currently, she holds a portfolio of Y, W, X, Y, Z. Those are the portfolios. These are portfolios, not. Now, she holds a portfolio of shares in 4 companies, so these are the companies. So the total makes a portfolio. The 4 companies makes portfolio. Number of shares held. Then we have equity beta, we have market price, then we have expected return. So the same way, can we start and get our, we are told that the current market return is 14% per annum, and we have the treasury bill yield, that is 9%. Then we are being told that Roman 1, the risk of Mary Chege's portfolio relative to that of the market. So what do you think that we need to get when you want to get the weight? When you're told to get the risk of portfolio relative to market, it means that you need to get the risk of portfolio. You remember the way we were getting, we were having a risk for X versus risk for Y. You could be able to get the risk of the portfolio when you're looking at the two. Still, you could get risk for this and then risk for this. How are we getting the risk? We are getting how each varies from one, right? So we will have, we were having X minus the expected return of, right? And then relative to Y. So this one we're getting, this one, Y. Expected return of Y, return of Y relative to the minus expected return of Y, right? So times the probability, so that is 0 point whatever, that was the probability. So we were looking at the risk of X relative to the expected risk of Y. But now they're talking about the market risk. So the first thing that you need to do, you need to know what are the weights? What are the weights of each? Can you be able to get the weight of the investment that you have? The weights on the investments that you have. Let's look at this. We have been told that they have invested some money. Like how can you get the weight that you have on this? So these are the number of shares, and then the market price is this. So you can get the total investments deal. In Y, in W, we have 10,000 times 130. That is the price for each share, 130. So what is the total market share for X? Market share. So you have X, that is a company, then market share. Can we get, so for X it is 10,000 times 130, which is giving you 1. right? 10,000 times 130, and then for x, that is for w. Then we have x. X is 15 times 100. That gives you. Somebody is trying to help me. Which year? November 2016. So we're going to have that one is we have 150 or 1500, and the other one is 15 also. 15 times 90, which is 15 times 90 is 1350. Then we have Z, which is 10 times 160. That gives you 1600. So what is the total investment? The total investment you can get here now, the weight for each, you can be able to calculate. Total investment inakuja ngapi? 5,750. Now the weight, you simply have this all over 750. So we can have, for example, 13. This is the total investment here. All over 575. So the weight for the first one should be 0.0. Zero point 226. One. Can you get me the weight for the remaining ones? You have seen how I've gotten the weight for the first one. Can you get the weight for the remaining ones? Can we have them in 2 decimal places or 3 decimal places? The other one is 2 point. 2 point. Then we have 0 point. And this one is 0.26. Then we have 0.23. I always say that let's have it with more decimal places. So 610. Yeah, that is okay. 7. And this other one. Yeah, 3 and ngapi? 4, 8. And the last one. You pay the last one, 27. What is the full figure? 27 what? Is it only 27? $83. So now, even if you had round it up, it should have been 27, 28, 0.28. So that is the total. Those are the weights. Those are the weights. Now, when you are given, like this, what are they giving you? They call risk here, equity beta. They have calculated for you the beta already. So we can be able to get the total beta for each, for the portfolio. Then we can be able to compare with the risk in the market, which is the market beta. So we have this times the weight so that we get the total beta, because they're telling you the risk of Mary's portfolio relative to that of the market. So you want to compare. So you have beta where we were having for X. So you say that beta of the portfolio is 0.226 times, they have calculated for you already this, plus this one is now 0.2607 times 0.899 plus 0.2348 times 0.7 plus the last one is 16. So we have 0.2783 times 1.6. In other words, we are saying that risk in terms of beta of a portfolio, which is the portfolio beta, is equal to weight times beta of each asset. That is, it is the same as the sum of weight times beta of each asset. When you're given beta, what you need to know is the weight for each. After you got the weight for each, you multiply the beta for each, and then you're going to get the total. So you're saying that risk, in this case, they refer to risk as beta, where we're saying that beta of the portfolio is basically the weight times beta of each asset. Then you get the summation of weight times beta, the total. So what are you getting as the total? What is the total? Beta of the portfolio. So one thing that I want you to note is that the standard deviation, you are able to see how we got the risk in standard deviation. You get the square root, then you get weight for 1 times risk for 1 plus weight for 2 times risk for 2 plus, of course, they were squared. Weight squared times risk squared for 1. That is the first security. That long story that you are having, that was risk when we call it standard deviation, when it was like that. But when it is now better, that was for this. When it is now better for this, use this formula. Better for portfolio is different. Very simple like that. So don't have to go through a long process the way we did this. That was portfolio standard deviation. Both of them are called risk. Standard deviation is called risk. The beta also is risk. But for beta, you get the weight, then you multiply with this like that, get the total. So I'm just asking, have you gotten the total for this? Unapata ni ngapi? Ama nimepea time kidogo. Now, you're getting 1.093. That is what you're getting. Another person, is that the correct one? Now, those who went through this topic, videos, what was the market risk? Because we are told relative to that of the market risk of the market. What is the market risk? Market risk. Market risk. Can somebody tell me the value of market risk? Market risk in ngapi? I want to see that you went through the videos. Now, ukapata market risk. What was it? The value of market risk. Topista, hatukuona hiyo. Market risk ni ngapi? Ulikutana na market risk mahali ukiwatch hiyo topic? Ruth, yeah, ulipatana nayo. It is one. Thank you. Market risk is what? Yeah. So market risk, which is now, we write it like B, M is 1. So they're telling you that now you need to compare the two. You have this one, you calculated to be 1.093, but this one is. So what does that mean? It means that the risk in this particular portfolio as a whole is higher than the market in the general market risk. All right? Tunaelewana? If market risk is 1 and the risk in the whole portfolio is 1.93, it means that this portfolio has got more risk than even the average one that is market. The average one that is in the market is when you don't have to invest in risky portfolios. That is the market average risk. Now, what will be your conclusion? You say that the asset is, you compare and say that 1.093 is greater than 1. Meaning that it is very risky more than the market risk. It's very risky more than the market risk. The portfolio has got higher risk more than the market risk, and that is what they wanted you to mention, comparing average. It's more than market risk. The other question, just want to do one, then we stop there. Determine whether Mary Chege should change the composition of her portfolio. How do you know that? How do you determine this? When you want to know whether portfolio is good or not, you need to change. Which formula are you supposed to use? Can somebody tell me which model are we supposed to use? Hiyo pia uliwatch. So tell me, which model are you supposed to use?
Simu yangu inachaji Rachel.
Which one are you supposed to use? Which formula? Or model?
Wewe unachezea shini game.
Leo umekuwa mkali aje.
Nafikiria ni mjinga.
Haya. We have other things that you're supposed to look at, which I hope that you went through. We have CML, that is capital market line. We have KASNEB, which I hope that you also went through. What is happening in WhatsApp group? Mtu anakufa huko. But that is what you've been taught right now. Florence, mbona unanirudisha nyuma? Look at what we said here. Zero risk portfolio, there are portfolios that have zero standard deviation. They have zero risk. There are portfolios that are created by extremely risk-averse individuals. So if the examiner asks you here that require the proportion that an extremely risk-averse individual will place, surely you want me to go to these questions? Na ndio nimefanya hapa sahihi. It's not fair. It's not fair because ni kama unanirudisha mahali nimetoka. So I'm just asking you, did you manage to go through these areas that you need to understand? Jensen model. We have trade, trainers model. Then appraisal ratio. Appraisal information ratio. Appraisal information ratio. Then Modigliani and Miller. Modigliani and a million model. Then the last one that you must go through is arbitrage pricing model. Arbitrage pricing model. Now, the one that I've asked you how to get, I'm sure that is something that you should have done, or at least you should have seen it somewhere. The appraisal model. You saw this formula, which was like X. That is it. What does this mean? ERS minus KASNEB of RS alpha. So that is what you should have used to decide whether the portfolio is okay, or an asset is okay, or asset is not okay. That is what you should have used in that particular area. So alpha value is what you shall use to know whether the portfolio is efficient, inefficient, or super efficient. So go and review that. Thank you so much for this time. alpha value, we'll be able to help you know whether the portfolio is efficient, super efficient, or inefficient. So using the information that I've given you, can you calculate the alpha values for those items that we have done today? How do you get the alpha value? You need just R return for S and the KASNEB return for S. KASNEB return for S, you know, still. KASNEB return, these are returns are given there. We have 14. Are they given? The returns are given here, 18, 23, 11. Those are R's. Those are R's. Then KASNEB is what you're now calculating. So KASNEB, the formula for calculating KASNEB is KASNEB return is equal to RF, which you have been given. So this is clear to my bill. Minus ERM, no, plus ERM minus RF into the risk for that particular security. So it is risk for 1. So if this is for 1, then that is the answer that you're going to get. Whatever answer you get here, you'll compare it with this, right? So you'll do that, all of them. Answer that you get here, utaweka hapa, na hapa ile umepewa 18 minus the answer that you're going to get here. For each asset, we have how many? So you'll compare this asset 1 and its KASNEB return 2 and KASNEB return 3, all of them. Now, how will you know that a portfolio is inefficient? The one that should be replaced is portfolio is a group of assets, so they are there together, all of them. The one that you replace is the security that is not doing you well. Ukiona ile ina underperform, the rest are okay, but moja iko na shida. That is the one that you're going to remove. So once you've gotten the alpha values for all of them, some of them will be positive, some of them will be negative. The one that is negative is inefficient. That is portfolio that is not doing well. Remember, that is an asset that is not doing well in that portfolio. You have so many assets, but one is not performing well. Hiyo utapata value yake hapa ni negative. Ikiwa negative, we are saying that it is inefficient. Ikiwa positive, it is super efficient. Ikiwa 0, how do we say? If it is 0, meaning that they are equal, 0 is efficient. So we have inefficient, negative, super efficient, positive. Efficient is 0. Efficient, it means that the expected return and the KASNEB return is the same. That is efficient. So if you are told that how can you make the portfolio become better, or how can you improve your portfolio, you simply remove the one that is negative. The rest will now be positive. Sasa hiyo yenye iko negative ndio unatoa kwa hiyo portfolio, then the rest are okay. So you need to change the one that is negative. Sasa, since it has inefficient portfolio, that is the only thing that you need to understand there. So I hope that the rest you can be able to do. So what was the question? Determine whether he should change the composition. Yes, he can change if you get one of them is negative. If they are all positive, you don't need to change. Sasa, if all of them are positive, you don't need to change. But you have to appraise each security, and the only way you can appraise each security in the portfolio is by using alpha value, which I'm sure you have watched that in our videos. So let's stop there for now. And then we shall pick from there in our next class. Now I'm seeing here, you have been given the variance, which is the square root of that. Covariance is given. So Florence in direct, we have a variance of X, variance of Y, and then you are also given the covariance of X and Y. Then you are told that how can you get the weight? Just get weight for one of them. Which one can you easily get? Just one of them. Ilikuwa la setting. 4 marks, imagine. Topista sio unaweza fanya. So that is okay. So let's stop there. We shall pick from there tomorrow. God willing. So I say that tomorrow we need to have 2 classes for FM. One will be to look at this CML, or are you okay with CML? I wanted to look at CML, and then we look at the valuation of bonds. Those 2 areas. Though in the videos that you have, all of them are there. There is a video for valuation of bonds. There is a video for CML as well. Ujue kuchora CML and then valuation of bond. Hujanijibu swali. You want August 2023. Wapi hiyo question paper? Niangalie, maybe tutapitia hata kesho. Can you share it on WhatsApp, the question paper for August 2023? Laura, nani? Topista. Hiyo August 2023 paper iko wapi? They are saying that an investor has decided to invest 2 billion in shares of 2 companies, namely Delta and Alpha, Delta and Alpha. The projection of returns from the shares of 2 companies along with their associated probabilities are as follows. So you've been told there. Then, so you have the returns, the probabilities, and determine the proportion of each of the above shares required for formulate a minimum portfolio risk. That one you can get. So here tumesema. The amount in shillings that should be invested in each using the portfolio determined above. Once you know the weight, you can now multiply the weight times the 2 million per your amount in shillings. Then the last one, describe the factors that could significantly impact on the price of cryptocurrency. Sio niliwapea assignment. Ama hiyo ni gani? Question C au hiyo ni B? Tunasema question 1C, Roman 2. Mi naona question, are you talking about August? Question 1C, Roman 2, hakuna. There is only question 1C, which says describe factors that could significantly impact on the price of cryptocurrency. Sinio? Not that one. Oh, in 2022. Sorry. Wewe ndio unani confuse nani Ruth. Wapi hiyo ingine ya 2022 hiyo tumemaliza. Wapi hiyo ingine hiyo yako? Topista hiyo question iko wapi? Ruth amenitumia ingine hapo na hiyo tumemaliza. Topista. So you are saying that in case of inefficient and super efficient portfolios above, compute the standard deviation that the portfolios should have for efficiency to be achieved with a given expected return. So that means that I have to do these questions and then share with you, because it is not the one that we are doing. You have gotten the efficient, and then now you need the standard deviation. Compute the standard deviations that the portfolio should have for efficiency to be achieved. So nitaangalia your question, alafu nione solution yake. I share on WhatsApp. Question 1. But hii question 1 tumefanya nani? See, tumefanya. There is the example that I gave, or I didn't give that example in class. Hii hapa ni kadogo. Hii one ni kadogo. We don't need to do a lot of things. That is about certainty equivalent. So out of these two required initial investment, so we have between certain amount. So certainty equivalent coefficient is 181,347 all over. The total expected is 200. Still, this is the one that you are certain of, but the total that you expect is this. So what is the certainty equivalent coefficient? Is this of this? At the end of each period, the risk period is this. So what is the cash flow? Generated cash flow, it is expected to generate cash flow of that 2,000. The net present value of the project incoming certainty equivalent coefficient. Now that you have said, can you be able to calculate it? Also share April 2023. Where? Now that you have certainty equivalent, can you now move from there? Ruth, ukiwa na certainty equivalent hivyo, can you now move from there? Or you only needed the sec and I've given you, so you're okay. Thank you. Sawa sawa. Haya. See you. We shall be able to look at that one because it is quite long. Then I share with you on WhatsApp. So, have a good night.